everyone's time. Recording's going.
Here we go.
All right, guys and ladies. My name is Michael Mahoney. I'm one of the principals of Upgrade Partners Capital. You can see my other partners, Joe and Brandon, and our other partner, Nikita, is going to be joining as well. Today is a little more of an introduction, but also a question and answers. We're going to open it up. We've done a few presentations on Upgrade Partners Capital at this point, and we want people to feel super comfortable, very easy to invest with us. So we want this to be a forum where you can get to know us a little more. We have our pitch deck. You can see our bios on the pitch deck. We have a new data room that we're starting right now that we're going to be putting together all of the information about everyone who's in the fund. Basically, all of our resumes will be in there. Our pro formas, past pro formas of the operators we're working with. So today is going to be more of an open forum. We're going to show the pitch deck. If you were to invest with us, what your risk and returns would be, and then some future hindsights of what we're looking at. And we're also going to let Patrick Duffy, who's one of our great operators, speak a little bit about what his investment style and philosophy is and some of the things that he's been able to do with us. So again, my name is Michael Mahoney. I live in Denver, Colorado. Been mostly in the single family residential fix and flip world for about 7 years and been doing multifamily with Joe Rinderknit for the past 3 years. And what I do currently is, along with Upgrade Partners Capital, I'm a business director at a mindset performance training company called Upgrade. We work with elite mindset people, and we do a lot of consulting for the businesses. So on the day-to-day, I interact with a lot of people who are always looking to not only get return on investments with themselves, because the greatest return you get is investment into yourself, but also moving their money into great investments. So by working with these kind of people and working with Joe and Brandon, we realized there was an integration. There was an opportunity for us to put together our skills, and that's kind of how Upgrade Partners Capital was funded. I'm going to kick it over to Joe now. I want everyone here to feel good about if there's any questions that you ever want to get to know me. Of course, my name and email will be in the pitch deck, but we want to have this be completely open and transparent. So feel free to reach out to me, and I look forward to getting to those though I do not know yet on this call too. Joe?
Yeah, thanks, Michael. Appreciate all of you that are on here. A few of you I know, some of you I don't, but I'm sure we'll all get to know each other really well shortly. Really excited about the opportunity that we have here with all of us. We all bring our own level of experience and specialties, and we feel like we have really created a powerful fund to put your hard-earned money to work, as well as other investors that you may know that you would think that would be interested in this opportunity. So my background, just quickly, is been real estate, multifamily. I've been an operator, and I see that going forward, the great opportunity that we have right now is with what's coming ahead and having a lot of dry powder, if you will, money ready to go for deals. So I'm really excited about that opportunity and to work with operators like Patrick Duffy, who's on here. Ryan Lawless, our other sponsor, is out of Denver. We'll give a quick bio on him as we go through the deck. He's got about 2,500 units. Was unable to join the call because he has COVID, unfortunately. So we're sending good vibes his way. Brandon and Patrick, why don't you guys intro yourself really quickly, and then I can dive into the deck and who we are as a fund and timeline, and get into some of the meat and potatoes of what we're doing here.
Yeah, totally. So I'm Brandon Nye, one of the principals of Upgrade Partners Capital, and my background is a little different. So I come from, I'm a sales director at a med tech company. And I came into the real estate world with a lot of curiosity. I've always wanted to be in it. And that started about 15 years ago. My interest was in it. And I always just found it so overwhelming to get into buying apartments or buying commercial real estate as an individual investor. And so, when I met Joe, we talked, and the world went from black and white to color, for like in the Wizard of Oz, when it goes from black and white to color. Like, it just made sense that real estate is a team sport, and you really have to approach it with not like one person, but more like a football team. Like, there's got to be the right people to play all the different roles. And so that's how Upgrade Partners Capital came together. I came in as a passive investor into a fund, and part of that fund invested into Patrick Duffy, into some of his properties. And he's on here. We throw these terms around like operator and sponsor. Maybe I should explain what that is, because that was super confusing to me as a novice investor in the real estate world. So operator or sponsor is the person that actually buys the deals, operates the deals, takes them down, fully runs them, does the asset management, does the rehab, runs that team. They're almost like the CEO of the apartment complex that they buy. And so what Upgrade Partners Capital would be an equity partner in that business, that, as part of that business. That was confusing to me, but once you kind of see the numbers and understand, okay, how if I deploy money, how does it come back to me? How am I making a return on my investment? What's my level of involvement, as a limited partner on, in a fund? And I can tell you what's fun about this is being in a limited partner investor in a different fund is you get checks, and they come every quarter, and they're consistent, and they're taxed at like a much lower rate. And it's been really, really big confidence booster in terms of being a part of the multifamily world, and bringing friends and family into it, and having them get checks every quarter and every month, and seeing their wealth grow. And in a time when the stock market, there's some of us that are involved with InMode, which is the company that I'm a director at, is we saw our stock go down in the past 6 months almost 75%, when our fundamentals of our company have never been stronger. And it's just macro level environment, Wall Street stuff that is so out of our control. So that's where it really feels good, and is nice to be a part of something where you're investing into a real product that has real cash flow behind it, and the market supports it. So that's what this is, kind of like really, really elementary. That's kind of my view on it as an investor and as a partner in the fund. So, Patrick, I'll kick it over to you. I think what's cool about Patrick is he's a very, very smart guy. He's very humble. He's not going to tell you how smart he is, but I'm always impressed whenever we get on one of these, and he talks about the current state of what's going on. He's got his thumb on the pulse, and he also under management has, Patrick, you can tell the number, but it's thousands of apartment doors that he's got, and he's has under management. So he's an expert, and he has shown his investors better than advertised returns, and that is something that I'm proud of, and that I would bring my friends and family in to speak to us about this. If I felt like it was like a risk, I wouldn't put my reputation on the line. So that's where I am with this. But Patrick, why don't you kind of tell us what's going on in the market, and what you're seeing out there, and how UPC fits into your business?
Absolutely. Well, thank you, Brandon and Joe and Michael, for having me as always, and nice to meet you all on the call. My name is Patrick Duffy. I'm a principal with Cormark Residential, based in Frisco, Texas. I started my career in commercial real estate back in 2013, and started out as a commercial real estate lender. And through lending, became very familiar not only with the various ways in which the capital stack can be constructed for acquiring properties, but also kind of some of the best habits of operators that we were lending to. And I had an opportunity to buy my first property back in April of 2017. That was a 58 unit property in Memphis, Tennessee. And since then, I've purchased just over 4,300 units. We've sold about 600 units of that total. So we have just under about 3,800 units in the portfolio today that we still asset manage and hold for our investors in our portfolio. And we're actively coming upon some of those anniversaries of those assets and looking to sell those as well. We've seen a pretty amazing appreciation of those assets over the last 18 to 24 months as more capital has come into investing in hard assets and multifamily. And many of the properties that we've purchased between Memphis, Tennessee, Montgomery, Alabama, Jackson, Mississippi, they would be categorized more of a workforce or Class B minus quality housing. So these are properties built in the 1970s or early 1980s that typically were purchased because they had a distressed component to them. The previous owner wasn't spending the money needed to bring the properties up to a nice level. There was a lot of things that maybe the property owner didn't have capital to address or didn't have the willingness to address things that needed to be addressed. And so we would come in and through our relationship and vertical integration with a construction company called Heritage Construction, we were able to really take advantage of some of these opportunities and come in, renovate a lot of units in a short amount of time, replace roofs, install new parking lots, landscaping, security measures, gates, lighting, you name it. We would kind of come in a kind of a shock and awe scenario and really add value quickly to our assets and make rapid change within these communities. And as a firm, of the assets that we've sold, we've averaged just over a 40% net IRR to our investment partners. And so we've been very fortunate to buy right and execute our business plans and deliver those returns to our investors. That's certainly not what we advertised at the beginning of the project, but those just happen to be very, very good outcomes that we were happy to deliver there. And as a firm and as a direction of the firm that we're taking it in, and it kind of brings us to the current day, we had bought these 1970s and 1980s vintage properties, and we're starting to now come to the end of our value add life cycle and really maximize the value of those properties. And now we're looking to sell them, return capital to our investors and book in and lock in that great return for them. And now we're turning our sights more towards a late 90s or early 2000s vintage product in markets like Dallas, San Antonio, Nashville, some more kind of Sun Belt cities in the Southeast with some high population growth and very vibrant economies. And not that Memphis doesn't have a vibrant economy for the workforce population, but we just in COVID and during the pandemic just saw some things among that renter pool and income level that really, frankly, for me, made that type of property not as attractive from a risk reward standpoint. Not only are these properties going to be 50 years old in a couple of years, but at the prices that people are willing to pay or you're forced to be paying for some of these properties, that juice of the return is no longer there, in my opinion. And so what I see as a much more favorable trade-off going forward is within a late 90s or early 2000s vintage product, you'd be surprised at how dated some of these projects can be, yet they've been built so recent that they still have very good bones. They're typically very well located. And you can come in and really just give them a contemporary upgrade from an exterior paint, amenity upgrade, go in, put in stainless steel appliances, lighting, quartz countertops, smart thermostats, smart lock packages, washer and dryer in all units. And luckily, with our vertical integration with our construction company, those are things that we can do pretty rapidly. And we think we have a competitive advantage operationally there. For that level of effort, as opposed to the workforce housing where you're maybe talking about $125 to $150 rent bump, within this newer vintage product, you're talking about a $250 to $300 rent bump for effectively the same amount of CapEx dollars spent. And so fundamentally, we just believe that's a much better risk reward trade-off and kind of where we want to take the business and scale Core-Mark going forward. And the guys at UPC who I've developed a good relationship with have seemed to buy into that thesis. And a lot of the folks that I talk into the industry are starting to make that kind of migration themselves. And so, yeah, I'm very excited for the future and have started underwriting some transactions that fit that mold perfectly. And they're very compelling. And really the only thing that And I talked to Joe about this the other day. The only thing that's kind of stopped me from aggressively offering right now is just kind of what's been going on in the debt markets. Interest rates have risen pretty substantially, pretty quickly here in the past 30 days. And I just kind of told Joe that, there's a lot of price softening happening right now on the side of sellers. People have brought properties out to market and have been asking X, and people are getting quoted in their debt quotes at substantially higher rates. And so they're having to come back and offer Y. And so I'm just kind of looking over the next 30 to 45 days to see where pricing is starting to shake out, or how lenders are now reacting to that kind of new rate environment before I really go out and start chasing product out there. But I'm definitely seeing a lot more of that product come available for sale. The opportunity is absolutely there in abundance. And I think within a rising interest rate environment, it makes sense to really make that move to quality assets, as opposed to some of the more distressed value add assets I had been kind of brought up on. And so I'm very excited to take the firm in that direction. The only thing I'll say, and then I'll turn it back over to the UPC guys, is the way that Cormark and UPC intend to work going forward is Cormark has engaged with a Dallas-based investment bank called Commerce Street Capital. And Commerce Street Capital is going to be representing Cormark in about a $300 million equity raise for these types of future acquisitions. That $300 million represents 90% of the total equity that they will contribute to Cormark projects. And so it's expected that Cormark will bring the remaining 10% or $30 million of equity to pair with that 300 million. And so myself, my partners, we will be investing in our own co-invest fund. And then we've invited UPC to come in alongside us as well into that co-invest fund. So essentially the funds that are invested in the UPC fund will invest in Cormark projects alongside major institutional investors as brought by Commerce Street Capital, which I think adds another level of due diligence rigor to make folks feel safe investing in these types of projects. It's going to go through a multitude of layers before any one of our projects is approved for investment and closing. And so I think it's a pretty unique opportunity to invest side by side with some larger institutions and family offices. So.
Patrick, can I ask a quick question?
Absolutely.
What is the relationship between Cormark and UPC? And Michael or Brandon or Joe, you might answer that as well, if whoever's most appropriate.
Yeah, so I had become friends with Joe Rinder Connect here over the past 2 years, and was consulting with him on various asset management items related to some of his properties. And we were collaborating back and forth on some of my acquisitions as well. And so it really began as a friendship. And then I met Brandon, who had an interest in gaining exposure to multifamily, and he actually invested in a portfolio that I had originated last year in Memphis, Tennessee. And that's proven to be a good investment for him and some of his friends. And I then met Michael through Joe. So it started out as a friendship and then became a working relationship until we're at the current day here.
So you guys y'all do the same thing, kind of. You're just aligned.
Correct. Yep.
Okay. Thanks.
Yeah,
By the way, I'm in Nashville. It's a great place to be.
It sure is. Love Nashville. Where in Nashville are you?
I'm actually in Franklin. We're just south of town.
Okay, I've actually been looking. I love Franklin. I was looking at some deals in Rutherford County. Actually, there's quite a bit of product that's popped up there. So
yeah,
that's right in your neck of the woods and right near the Nissan plant.
Yeah. Yep. Nice. Thanks, guys.
You're good.
thanks, Frank. Really quick, before we get into the deck and get into some more details, does anybody have any questions for us? If not, we'll get right into it.
I did scratch out a couple more, if you can bear with me.
For sure.
I got 3 of them, I guess. You mentioned, Brandon, that you get checks quarterly. And what caught my ear was the nature of the taxation on those checks. I'm sure that's why we're all here, pretty much. But
Yeah.
How does that break down? Is it interest? Is it dividends? Or is it capital? How's that come together? So I'm sure at the end of the fund, you'd have disbursement to be separate from that.
Yeah, so the way it works is there's a preferred return that you would get as a investor into the fund. So every quarter you would get a 6% preferred return on the money that you deploy. And the way that it's taxed is you get a K1, and all of the depreciation that is done on those properties is passed through to the limited partners on in the fund. So like I got just round numbers, last year it was like 30 something $1,000 is what I got in dividends and preferred payments, but I only had to pay taxes on 20% of it because of the depreciation that was carried through as an investor. So they get to do what's called a cost segregation study. So they are able to accelerate depreciation, and what that effectively does is it lowers the amount of taxes that you pay on the preferred return. There's also, and Joe, it might be helpful to just show these numbers. I know I'm visual and I'm definitely like a math guy. Like if I'm going to give you my money, I want to know what I'm getting back and what's on top of it and how does all that work. So, let's say you invest a certain amount of money, you would get a multiple of that money back when we do exit the fund, which we're targeting to do in 3 years. So, Joe, I don't know if you've got that where you can pull that up and just show what that looks like.
Give me just a minute. I can pull up my.
And just to add a little bit further context to that, the nice thing about apartments is, unlike residential where depreciation is just kind of straight line over 27.5 years, with apartments, we hire engineering firms to basically categorize certain elements of the property in 5-year timelines and 15-year timelines. So we can really front load a lot of that depreciation and really maximize our write-offs during the hold period. So it's really, really beneficial.
Makes sense. Someone mentioned a 40% IRR. Is that annual, or is that?
Yeah. So for my projects that I've sold, I've averaged about a 40% IRR to my investors, which would be an annualized return.
And then the last question I had to do with the funds. You mentioned a 3-year exit, and I'm used to seeing 7 to 10 year fund lives, maybe closer to that 7. Is this are we investing midstream, or is this a fund that's about to open, or what's the nature of that? What's the commitment time wise too?
Yeah, awesome. Good questions. So we, when we came up with this fund, we were really kind of working closely with Patrick on kind of the tempo of the market and how long the hold periods would be on the assets that he would purchase. And we wanted to coincide with that timeline. The longer holds that we've seen traditionally have been a model, which is a cool model. It's just not what we're going for, just due to what's happening with the debt structure and inflation. Is prior, on a longer term hold, you'd buy, rehab, refinance, get the investors back their initial capital, and then hold it and pay cash from there, 7 to 10 year. And that's a cool way to do it. With this, there wouldn't really be a refinance. We would add value and then sell. So that's why there's a shorter life on the fund, because that fits the thesis of what we're trying to do in the marketplace. So
That's exactly right, Brandon. Yeah, I and just in talking with the guys and relating kind of my experience in my portfolio, I bought properties, added value, refied, held on, and then sold. And there's some properties now that we are simply adding value and then selling. And in the latter scenario, it's really about maximizing IRR. And based on a lot of what my colleagues have done and really what I see from an opportunity standpoint, we really complete all of our value add or substantial value add within the first 24 months of ownership. And so it really kind of makes sense to harvest that gain within the 24 to 36 months in order to redeploy that capital and then just begin that growth cycle again. And so that's kind of what's driving that timeline thesis.
Appreciate that, guys. Thank you.
And then in terms of deployment of capital, so we would have a capital call when we've got a deal in hand. We're looking, our goal is to have that done in the next 90 days. So we would be, looking for commitments. That wouldn't mean that you would be exchanging funds with UPC like tomorrow, and then you're waiting for returns. It would be like, hey, when can we put this into a deal so that money's active and working? And so that's how that would work. There'd be a capital call.
Yep, and to give you a little bit more clarification on the timeline too, we've got a goal to raise the 25 million within the next 90 days. So our goal is to, by September 1st, have hard commits. And then by September 1st, based on like my conversation with Patrick, with Ryan, I mean, once you have a deal under contract, it takes at least the 90 days to take it down, right? So you can expect that, by September 1st or shortly thereafter, we'll at least have a deal or two that we'll be doing a capital call on to deploy that money towards. So you're at the very beginning of the fund and us raising the money and deploying it.
Curious, are you guys set up at all to handle retirement type money, or is this all taxable?
Self-directed IRA vehicles or solo 401ks?
Yeah.
Yes, absolutely. They all forms of that can be accepted.
Awesome.
Yeah, 1031 money, we would have to run it through SEP in a different way, but yeah.
Okay.
Wonderful. All right, any other questions at the moment?
Back to the terms, are those fixed on the initial date of commitment? So Joe, you had mentioned September. Would that be the start of the 2 to 3 year cycle with a fixed end date?
Yeah, good question. So once the money is deployed, right, it'll be the first quarter after the money is deployed. So we would say, by December or end of December, you would receive your first distribution as long as that money was deployed, say by 1st of September.
And then I think Tom was asking about Fund Life. Would that start
Oh, I see.
at the beginning of September? And that's when it would begin.
Yeah, when the money's deployed is when the life cycle of that deal or the fund would start. Yes. Yeah, but we would not take your money unless we had a deal ready to go.
Right. So then it would run at the fixed return. And then at the end of the term, there's potential for the wrap up, if you will,
Yes,
to provide a greater return. Okay. Understood.
of course. Yeah, and let me actually share my screen quickly for you. Where is give me 1 second and I will pull it up just to put some visuals towards what we're offering. Because at the end of the day, right, that's what everybody would like to know is how am I getting paid on this? All right, can everybody see my screen?
Mm-hmm.
All right. So to answer your question, Tom, right, we're offering a 6% preferred return with an 80-20 split. So essentially what will happen is, for example, Patrick's got a deal, we're invested in it. And at the end of the day, after, we received all income, all expenses have gone out, the debt service has gone out. Say we have $10,000 of net income, which is like cash flow in your pocket. The investors are going to receive 80% of that, so $8,000. And depending on how much money you put into the fund, there will be a percentage of that capital pool that you will own against like the entire raise, right? So whatever that pro rata share of the capital pool you own will be what you receive, if that makes sense. So you'll get that on cash flows quarterly as well as profits off the back end, which is actually like really exciting in itself, because as a fund, if we make $10 million profit at the end of the day on the portfolio of deals, the investors are going to be able to receive 80% of that, and then get their pro rata share. And so that's what's going to help you be able to get that higher IRR that, like Patrick talked about, and the higher equity multiple that we would be targeting. And then I guess one thing to note too, where it says that this upon achieving 6% preferred return. So like that 6% preferred return is like almost a guarantee that you are going to receive that preferred return, right? That's what you're going to get every quarter. Did that answer your question? And
Yes, it did. At the end of the term, can the overall profits be rolled into the execution of the next purchase to avoid a large tax impact?
that is something that we can definitely talk about, because after this fund, like I would think by the end of this year, we're going to be doing like $100 million fund. So if you're wanting to roll profits into like the next fund or the next deal, 1031s have their own level of complexity that it can happen. We would just have to figure it out with our legal team and make sure that from a cost standpoint that makes sense. One of my other business partners on here, Dean Ellis, we bought a property together in Brigham City last year. And he was able to write off enough from our cost segregation study that it made sense for him to like eat the capital gain. And so like that's another benefit to all of our investors, is they're going to receive benefits from the cost seg study that we can't necessarily put like a return metric on, right? But those are a few things that we'll be able to look at with your depreciation and what the gain is. But the answer can be yes, simply. Any other questions on that, Tom?
No, thank you for the clarification.
Of course. Does anybody else have any questions at this time? All right. If not, I mean, we've gone through pretty much the entire pitch deck just in Q&A and questions.
You can send it to everybody for review as well. So it's not,
Yeah.
and appreciating everyone's time. I think that would probably makes the most sense.
Yeah. I do want to vouch for really quick Ryan Lawless. He wasn't able to be on this call. But I wanted to just give you guys a quick, just some quick information on Ryan. Michael, are you able to talk about Ryan where you know him a little bit better?
Yeah, be happy to. So I met Ryan through a mutual acquaintance in the Denver market area. At the time, I believe his new company is now called Renegade, and he was working with Narrate at the time. And he's an interesting guy. Joe and I have had good conversations about how he does his underwriting, and just listening to him, he was very meticulous about how he analyzed properties and some markets that he was in. And he was telling me about some of the returns and how many units he had up to that point, and his history of how he got involved in real estate. So there was a lot of values that I resonated with him being a hardworking guy, and also being able to manage that many assets that he had and be successful at it. In the real estate world, and pretty much in any life, it's about what kind of results you're really getting. And Ryan's a guy who's been getting great results in the multifamily asset world for the past, I think, almost 12 years now. So Joe, why don't you pull up his pro forma of, I think he's got, as you said, 2,500 units, and he's in Oklahoma City. What other MSAs is he into?
Yeah, he's in Oklahoma City, Kansas City, He's doing
Colorado as well.
big deals in Colorado Springs right now. He's got some deals in Lexington, Kentucky, which is just across the road from where Patrick's investing. We need to get an updated one from this because I know he's not at 15. I believe he's at the 2,500. So
Yeah. The reason that I think Joe wanted to highlight Ryan is just, along with Patrick, the operators, the sponsors, however terms we're going to be using for these gentlemen, these guys are truly the strengths of Upgrade Partners Capitals because they're so good at what they do. And that's why we want to just simply do what we do as best, is go out and network and bring capital for these gentlemen that are getting great deals. Patrick talked about it earlier, how he was able to get a deal with Commerce, and they're going to be doing 90% of the underwriting for all of the deals that they do. So that is an extremely meticulous process that an institutional lender is going to be doing. Ryan himself has a great relationship with some banks and some lenders down in the South already. Brandon Nye is a part of a mastermind by this gentleman named Tim Bratz. I believe the mastermind is called Legacy, right, Brandon?
Yeah, I'm here now.
Nice. And so Ryan actually happened to know a couple of the lenders that this mastermind was a part of. So both Ryan and Patrick are very good at what they do. And we just want to give them more opportunities and give everyone on this call and everyone who's going to be watching this recording as well, the opportunities to make back money, your hard-earned money with great returns. So we want you to feel good about, obviously, this is not a sales call by any means, guys. We're presenting an opportunity too. And basically at the end of the day, we're presenting two gentlemen who have, done their whole reputations on really successful opportunities that they've done in the multifamily world. So hopefully Ryan gets to join us on one of these calls and gets to put a real face to the name pretty soon. But he's a guy that you guys can feel good about. When he brings a deal to us, he's done his own underwriting system, just like Patrick has, and just like Upgrade Partners Capital will as well.
One thing that I want to comment on between Patrick and Ryan is the strategies that they bring to the table are really going to help our investors hedge their risk, but also give them greater than average returns. So Patrick, right, most of his deal source is coming from on-market stuff from brokers and other reputable people that are bringing like solid 1990, 2000 vintage and newer assets that have operational efficiencies that are needed. And Patrick and I enjoy talking about new ways that we can add value to tenants to be able to bump, rents, even just a little bit higher, putting in a smart home system and a closet system, right, Patrick, and being able to increase rents $50 to $100 just because that's how tenants are appreciating right now and are willing to pay for. So like with Patrick's deals, they may be lean going into it, but on the back end, they're going to have a much greater return on the back end when we sell. Whereas Ryan, all of his deals are going to be off market. And so that's where we're going to be able to have more of that consistent cash flow, as well as the appreciation off of the back end. So different markets, different strategies, but the combination of them give our investors great returns, both cash flow wise and appreciation wise, cost segregation wise. And overall, you're investing in a portfolio of deals where we'll be buying between 5 and 10 properties with this fund. Your risk is hedged significantly versus going and investing in a syndication on a single deal, where all of your risk and all of your return is based on one operator doing one deal. And that's one of the great reasons why we wanted to do this fund and bring others that we know, like, and trust into what we're doing with guys like Ryan and Patrick. So, Christine, I see you have a question. If you want to come off mute and
Yeah.
question.
I just had a question on like timing. So if the goal is to have all the funds ready and raised in the next 90 days, and then instead of purchasing just one property, you're purchasing multiple with the fund. once all those funds are there and ready, when is it that you're hoping to have like everything lined up? Or is it just as opportunities present themselves, you just use the capital? Are they all purchased at once? Just kind of trying to understand that part.
Yeah. So we are what's called a pledged fund.
Okay.
So everybody here, next week we'll be able to send our PPM docs. You'll be able to subscribe to what dollar amount you're wanting to invest. And once we have that deal, we'll do a capital call. So it will be on as we get the deals basis, but we will have like a deployment period where we'll come and pretty much call all of your capital. So did that answer your question?
So it's like with a pledge, it's like you're saying, it's a hard commit.
It is a hard.
There's no like fund transfer until the purchase is ready.
That's correct. Yeah, we will not receive any money from you until we are ready essentially to wire funds to the bank to buy the deal.
Okay. Thank you.
Absolutely.
Yeah, one more point of clarification. I'm almost embarrassed to ask this, but
No, you're great.
the preferred return, you say quarterly. You get the quarterly preferred return. On this, the page you had up, it said 6%. Are you paying 6% per quarter? So you're actually out of this in 4 years, or is that the annual rate? So it's a 1.5 each quarter.
The latter. It's 6% annualized, 1.5% each quarter.
Okay, yeah, that's exactly what I thought. Okay.
Somebody else had that question too, Frank, so it wasn't a dumb one.
I have a question. Someone may have already asked this and answered it. I apologize. I lost service. I heard talk about 1031. As the money comes back in, can we just automatically reinvest that without actually receiving it as profit?
Yeah, great question. And Tom did ask that question. It is something that we will look at doing. We will most likely have a much larger fund going at the time that this fund is closed. So what we'll just have to do is get with our legal team and figure out what it would take to be able to invest those funds as a 1031 into our new fund. But it is something, especially for our first time investors, is something that, if you like and have enjoyed working with us, then we're going to do what we can to redeploy your funds. So we're flexible in that manner.
I think to maybe sum this up, if there's not any more questions, and just echo what Patrick said, is right now it represents a tremendous opportunity in the market with some of these people out there that bought stuff and didn't manage it well, and with interest rates changing and maybe their adjustable loan is now going to be changing, and they're kind of like, I got to sell these properties. There's people getting out of position on good properties, and they're now not asking for as much as they once were a couple months ago. And we think that that's going to soften even more to where we can come in and achieve these types of rates on really good product that doesn't have a ton of problems or heavy lifting or anything that's out there. So that's really what I'm excited about, is what's happening in the marketplace. A lot of people kind of get scared with the interest rates rising. I think that with good operations and a good strategy, it represents a big opportunity. So that's.
Yep. So really quickly, guys, we really appreciate you all being on the call. If you would, take a screenshot of, where'd it go? Right there. So this is our team's emails, our phone numbers. I can put these in the chat as well. We would love to answer any questions that you may have. Just so that you're aware, next week we will have our PPM documents and our subscription documents finalized. And we'll be reaching out to you. One of us on our team will be reaching out to you, seeing what you are interested in investing, if you're interested in investing now with us, or if you have other questions. So you'll be able to review those. And then as we have hard commits come in, we'll be also putting our front foot forward and getting some deals to deploy the capital and start getting some really good returns for all of you. So thank you all. And if there's no other questions, you're welcome to leave. Thank you all.
Thanks.
Thanks
for jumping on.
Good to meet you, Brandon.
Yeah, nice to meet you.
All right.
See you soon.
Take care, guys.
Here.